Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's guest has just taken on the CEO role at one of the global market's largest wholesale broking and specialist delegated underwriting business groups. As CEO of Ryan Specialty, Tim Turner has arguably some of the best visibility of the global insurance market and its stress points of anyone in the industry. The business that Tim has helped to build with founder Pat Ryan is a broad, deep, complex and highly efficient insurance distribution machine that picks up and serves wherever local markets are unable or unwilling to provide the insurance solutions that its retail brokers' clients around the world need. The firm works with over 20,000 brokers of all sizes and handles more than $25 billion in annual premiums. Ryan Specialty has also been a major consolidator in its segment, executing many large and complex deals on both sides of the Atlantic. In this podcast, I was able to quiz Tim on all the trends in the market, and he was really open and forthcoming in all his answers. So if you'd like to know where the major friction points and opportunities are, whether the boom in E&S submissions will continue, and wonder where ongoing retail broking consolidation and the continuing wave of MGA formations are likely to be leading, then listen on. You won't be disappointed, but more importantly, you'll be spending time with one of the sector's most successful, experienced and dynamic executives, and learning how he thinks about the insurance world and how he intends to make the most of all the many commercial opportunities it is currently affording a business like Ryan Specialty. Tim's also great company, and his drive and enthusiasm for our sector is undiminished, and I'll wager a listen will put a renewed spring in your step. Enjoy the podcast. Tim, welcome back to the Voice of Insurance.
Well, thank you, Mark. It's a pleasure to be with you, and thank you for the invitation.
I can't believe it was almost 4 years ago, I think, when we last spoke on this podcast, and lots of things have changed. Obviously, Ryan Specialty has now become a public company, and more recently, you've taken up a new role. Congratulations on that role. So, first obvious question, I'm sure you can bat this away very quickly. Should we be expecting any change of emphasis or strategy from Ryan Specialty going forward now that we've got you in charge?
Well, I think the announcement is less about change and maybe more about continuity in our strategy. We plan to continue on the path that both Pat and I built and staged. It's been a privilege to work alongside Pat and learn from his leadership since Ryan Specialty was founded in 2010. As you know, Pat is a true pioneer in the insurance industry, and his commitment to innovation and execution and exceptional outcomes for our customers and our trading partners has been unparalleled. Under his leadership, Ryan Specialty has grown into an extraordinary company with a dynamic and really a differentiated business model. So looking ahead, we'll continue to execute our strategy, of course, and it remains unchanged. We're really focused on a handful of things, maybe 4 that stick out and define us: delivering innovative solutions to our clients, the big one, generating industry-leading organic growth, executing our M&A strategy, and then increasing profitability and delivering additional value to our shareholders. There's a lot of great chemistry in our management team, and it's always a team approach when you're building a company. And we're all founding members of the management team, which makes it very unique. We just really need to keep doing what's made us great. And I would say, lastly, as a whole, I can't remember a time when our people were more excited. We're winning at the highest level, and we're delivering both organic and inorganic opportunities every day.
I certainly wouldn't have expected you to say that you want to change everything, because the success has been so meteoric and the strategy has been so clear right from day one, because I remember being there talking to Pat at launch, and actually nothing much has changed. And now, of course, it's actually even more transparent because, of course, you're a public company now and we can see the strategy. It's very clear. It's actually sort of in your shareholder documentation. So it's all there. Not much has changed, but certainly one thing that's changed is the balance of the business. Is there anything strategic about the way that's changing? Obviously, wholesale broking has been the absolute mainstay of the business, but the revenue derived from underwriting or managing underwriting and binding authorities has been increasing. Do you have in your mind any particular strategic level at which one should be the other? Or do you think these are things often down to the way the market is at the moment? You didn't have a particular design about what's an optimal percentage of your revenues to come from wholesale broking and from MGAs, MGUs, and binders.
Yeah, I would say that's accurate. We're really not targeting a business mix based on a financial outcome. As you know, our overall M&A strategy is aligned around the evolving and growing needs of our clients and our trading partners. So our focus is to continue providing a dynamic value proposition with them. And that's worked really well for us. And in addition to that, I would say Pat's vision from the very beginning was to align delegated underwriting authority with our wholesale brokerage specialties, bringing much needed capacity to these industry classes that are highly technical.
Yep.
We believe we have the best broking talent in RT specialty, and we complement that with excellent underwriting talent across a niche and diversified product set that lies across all our MGUs.
So it's more like whatever's going to solve the problem for your client is the best way of doing it. And if that means you need to start an MGA in order to corral that capacity that might not be there in the open market, then that sounds like that's what you'll do. But you won't say, oh, I really want this to be 60-40, so therefore I want to increase my underwriting revenue this year or whatever. So it's basically client focus, and it'll go and it'll fluctuate wherever the market and wherever that client need or solving that client need is going to take you.
Yeah, I think that's very accurate. And, we've always been client focused, and our clients want to get the best solution for their client. And we're very focused on that. And our retail broker partners, they want to work with the biggest, deepest, broadest solution set. So our strategy is really around that. And they like it when it's housed in one platform. And that's really what we're trying to build.
Something that's going to really solve the problem, but also do it in the most convenient and cost-effective way.
Precisely.
Well, in terms of that client base, it's changed, but it's not really changed. It's something that's always been there that's really come back, particularly at the very high end. Within major US retail broking, of course, we've been talking about consolidation probably ever since Pat really probably started it in that really major sense in the late 1980s. But it seems to have stepped up a notch again in the last year, particularly when we're talking about deals by the major incumbents. Obviously, we've seen there's been a huge amount of private equity fueled activity and other kind of consolidation type activity. But we hadn't seen the biggest two get involved as much in the last few years. But now that seems to have reawakened. Is this kind of development of any concern for you, or is it already in your playbook?
I would say we're not concerned about it. They're terrific partners and customers. In fact, there's a level where we're excited for them. They have a very clear strategy on what they need to do, what they want to do, and we're very open in our dialogue together. So no worries there. It actually plays into our strengths. We know our role. And as you know, retail broker M&A is one of the many secular and structural changes and growth drivers of Ryan Specialty. Importantly, both of our more recent deals have been in the middle of the market space. We work with over 20,000 brokers, from the globals through the top 100, which we refer to as tier one, maybe the next 400 or 500 retailers, tier two, and then tens of thousands of retail brokers and agents that we would refer to as tier three. So we have a strategy for all three of those levels of retail brokers and agents. The middle market, he needs both our expertise in RT and more products through our MGUs and programs and binding. So it's a multifaceted solution platform that we're building for these customers who really need our expertise and our creativity. They require more sophisticated services that we deliver through a high level of expertise in each and every one of these unique specialties. So we feel we're well positioned to continue delivering our services that most retail brokers value. And we think we're delivering it at the highest level.
Are you ready to unlock the full potential of data, AI, and automation in your business? Attend the Data Jam on November 28th in London, where insurance leaders and experts come together to explore how data can drive digital transformation.
From transforming your customer experience, streamlining operations, and staying ahead of the competition with cutting-edge technologies, you'll find the latest insights at the Data Jam. Dive deep into the power of AI, learn the latest in data management, and discover how emerging technologies are reshaping the industry, all under one roof.
The Data Jam is not just about the tech. You'll get real-world insights and case studies in underwriting, claims, and operations. Plus, you'll discover how to leverage data to drive innovation in your organization.
Make data work for you. Search Data Jam today and join the insurance leaders transforming their business and operating models. Use the code VOICE for a 20% discount. That's Data Jam, November 28th in London. See you there.
And of course, I cast my mind back to that Ryan Specialty kind of foundation point. And that was one of the original points of the thesis of why you're doing this, was because, consolidation has meant within the retail community, even back then, had meant that panels were being consolidated and were being rationalized. And that you wanted to be one of those top panelists that no one would ever want to remove, because you want to be the essential provider of wholesale insurance services.
Absolutely. It's always about elevating the deliverable itself, the solution. And we're very, very focused on that at Ryan Specialty.
Other things you've been very busy with on the acquisition side is over here in Europe. Done some big deals here. Pat particularly is someone who's almost invented the idea of a global broker. So should we now be expecting to see Ryan Specialty globalizing in the way that you and Pat know how to do? We're expecting to see more activity around those global wholesale insurance hubs?
Well, you're right. Pat does have an incredible global vision that has made so much of this expansion easier for us. Just tremendous leadership from Pat. And along the way, we've made a strategic decision. Number one, to avoid owning a London broker because of the potential channel conflict that we see with our retail customers. So we see Europe and the UK as a very fertile ground for delegated underwriting authority, actually. More utility for an MGU in Europe, where the risk is solved by the local market or shifted to the Lloyd's global market, if you will. The acquisition of Castell significantly enhanced our UK and European footprint, and set the stage for us to accelerate our international expansion. Castell adds over 10 different MGUs, most of which were new offerings for Ryan Specialty, and 2 that further strengthened and enhanced existing MGUs for us. There's a structural advantage of being there with boots on the ground. We have a very strong management team that has the local relationships and knowledge. Big advantage. We also expanded into Singapore, you might know, 2 years ago with Ryan Transactional Risk and our reps and warranty MGU. And as we continue to say, the delegated authority space is mature there, but very fragmented. We continue to be excited about the international opportunity itself, Mark.
It sounds like that's a big yes, and that we should be expecting to see activity at some speed from you. We'll be seeing press releases, I'm sure, coming in future months and years then. We're talking about Castell and saying that's another 10 MGAs. And it is almost astounding, particularly, I'm sitting as a journalist, the amount of MGA formation of the last decade has been phenomenal. And I thought perhaps when the market hardened 4 or 5 years ago, I thought that maybe this was going to put a pause on this. But if it was the most brief pause, it was very hard to have noticed, because there's such a wave of growth in MGA formation is still happening. Do you think at some point that will come to an end and that might turn into consolidation? And again, with you perhaps being one of the consolidators or a prime consolidator candidate?
We expect that there'll be a lot more consolidation. But with MGUs, there's a lot of new platforms out there that need more seasoning. So we see a lot of discipline on one hand in the MGU pricing environment right now. There's many experienced acquirers who know what to look for: solid underwriting results, unique products, and really high quality capital support for businesses that have these attributes, there's an attractive market. However, not all recent startups have this sort of track record yet. So
Yeah.
there's, again, a lot of seasoning to take place in the delegated underwriting authority space, in our view.
Well, I suppose you know more about it than most. And so, yes, if you're going to buy something, you've got to buy something that has a track record, that's something that you can really kind of kick the tires on.
Absolutely.
If one thing we all know in our business is that it takes longer than you think to really get a track record and to know that you've done good, because things can look good for 3 or 4 years before perhaps they don't later.
Yeah, that's so true, Mark.
What about wholesale broking itself? Again, another segment of the market, particularly in the US, where, of course, you have been one of the actors here, consolidating that marketplace. Do you think that's largely done now? Or do you think there's still deals to be done, or relatively big deals to be done?
Well, I think there's some that have said that, but I would say, look at our history. Last year, Ryan Specialty had a record year for M&A. We acquired businesses that really fit into all three of our specialties. With binding authority, we acquired Griffin in the Northwest, in underwriting managers with Castell, and in wholesale with Socius. Tremendous acquisition. And we did 3 deals that were the start of our benefits practice. So there are still deals to do in wholesale broking, more than you would think.
Are they more likely to be bolt-on type regional operations? Certainly when people describe the market to me, particularly in the US wholesale space, they say, well, Mark, there are loads more regional players than you would ever know of, because perhaps you're sitting in London, you can't see them the way we can.
Yeah, I would say that's true. There's dozens and dozens of what we would call super regional hybrids of combination of binding authorities and brokerage platforms. So we remain very ambitious on our outlook for M&A, for certain.
Certainly you're one of the most likely buyers on any investment banker's list, I presume.
Well, we like to think of it as a preferred destination. And so we do get a lot of looks, and we're very proud of that.
I want to go back to, again, some of those fantastic original premises Pat had with you when you were founding this business. Now that you're a public company, it's great to be able to read them all again in your investor presentations. And something this is I picked up again from having read some of your public investor presentations ahead of this interview, just doing my preparation. One of those theses was that the E&S share of US P&C market was going to increase. And of course, it's almost doubled since 2010. Now, just under 22% of the marketplace. Where do you think it could get to? Do you think it's nearly done? And of course, we've had this discussion before, I'm sure, about how much of that is secular, i.e. permanent change in the structure of the market, and how much of it is cyclical, because we know that some of it's cyclical because some of it ebbs and flows with the hardness and softness of the market. Again, how far do you think it could go? Because you've been absolutely right on that call, and it's been a fantastic, obviously a great tailwind or a rising tide to lift everybody, and you have risen with that tide magnificently.
Well, thank you. What we see today is that E&F flow remains very strong, and we see the stamping result. And you don't make a whole lot out of the monthly numbers or even the quarterly numbers, but these annual numbers are clearly a trend that we're seeing double-digit growth of new non-admitted property and casualty, and with no signs of the admitted market coming back into these high-hazard segments. We feel there's a number of reasons to be positive about all of that. Obviously, as you mentioned, secular and structural drivers of the risk. The big ones, climate change and social and economic inflation. So in these high hazard technical P&C practice group verticals where most of the business travels, the risks only continue to get larger, frankly, and more complex. And then on top of that, we have a more uncertain loss environment where E&S is just better suited to handle. As you know, the big advantage we have is the freedom of rate and form, and the ability for our insurer partners and underwriters to adjust more quickly to the risk. And now it feels like there's an increasing discipline in the underwriting community. So we think E&S growth should continue to outpace the growth in the admitted market. That's really the foundational change. May not grow in the teens or the 20s every year, but we should continue to take market share. There's also been a shift in the commitment to the E&S market, toward owning and acquiring dedicated and sophisticated E&S companies. That's been a big factor. The companies just have a better understanding of what should remain on non-admitted paper. In our opinion, it leads to less cyclical volatility. So difficult to put a number on it, but plenty of sustainable drivers in the E&S growth picture.
I suppose the ultimate thesis is it doesn't seem like the world's getting any simpler or less complicated. But if you're in the more complicated, more difficult hazard end of the market, then you're probably in the right place, given where things are going.
Yeah, that trend has clearly continued to expand and grow, and we don't see any end to it.
Do you think also that perhaps clients who might have previously and in previous cycles dipped into the E&S market as a last resort, perhaps now, because they're getting more sophisticated and better service, better responsive service, they might stay. They're staying because actually they're thinking, I didn't know actually that insurance could be this good, or it could be this responsive or this bespoke. Do you think that's part of an element because you're actually just performing better and you're more likely to retain customers because you're better at looking after them than you used to be?
I definitely think there's an element of that. The creativity and the ability to manuscript things like alternative risk structure is so attractive for more and more insureds. So that freedom of rate and form really gives us an advantage when creativity is needed. And we just see more and more of that for sure.
You've built this fantastic machine, this great net over the market, catching all the parts of it that are the difficult to do parts, and a great problem solving machine for the insurance market to help retail brokers out when things that used to perhaps be easier to solve or that were more vanilla become more complicated. Because of that, you've got this fantastic visibility over the market now, given your market share and your position. I wonder if you can tell me where the most pressure points are, where you're getting the most new inquiries from.
Well, with the wholesale volume at the level that it's at, you really get a keen insight into changes and to migration of risk. And so there's a few that come to mind that would be, I think, good illustrations for our conversation today. High net worth and ultra high net worth is a very, very hot segment right now. And we've made tremendous progress in getting in front of this one. We've hired producers, built our own MGU, and formed an exclusive with AIG's PCS. So we have proprietary product, we have broker expertise, we have all the elements of a real successful practice group vertical now in high net worth. Transportation, maybe most likely the loss leader in the reinsurance world. It's the poster child for social inflation, frankly. A lot of pressure, broadening into various areas of transportation. It's not just long haul trucking anymore, but really any commercial risk with a large fleet, thousands of extra heavy vehicles. Those risks need E&S creativity, whether it's a buffer, attachment point, a unique risk transfer platform for them. But now it's extending to livery, everything in livery, shared economy. Those types of risks are absolutely coming into the non-admitted market in droves, just a major dumping and shedding by the admitted market. Healthcare it's not just nursing homes anymore. We're seeing a lot of movement in hospitals, hospital professional liability, really under tremendous duress. And of course, social and human services now is so much broader in the United States in terms of its need for creativity in property and casualty solutions. So we do what we do in these practice groups that are loss leaders. We have several MGUs in social and human services, and we have a very deep bench in professional liability for that space. And then maybe everyone's favorite, sports and entertainment across every spectrum, tied specifically to large venue. Anywhere there's crowds, anywhere there's large gatherings. Unfortunately, here in the U.S., you have active shooter exposure. Unfortunately, you have sexual molestation liability sensitive type of accounts. Those all need real expertise in structuring and coverage issues. And so we're constantly working on enhancing our product offering and our moat in these areas. So we're making a long-term sustainable investment in these areas to strengthen our competitive edge.
In high net worth, is that down to limit compression, that kind of thing, in that admittedly carriers are just not putting out the sort of limits that someone who's got a high net worth property or series of properties and, nice bits of artwork and other things just can't get the limits anymore? Is that probably one of the main drivers?
Yeah, absolutely. Specifically, though, it's where you see real discipline in limit deployment. And so there is a compression. The limits are available, the capacity is available. It's just in smaller increments,
Yeah.
which lends itself to wholesalers and MGU specialists who can weave this capacity together and have strong coverage continuity in a tower.
Yeah. It's fascinating, but it sounds like that's almost across the board, isn't it? You're talking about property, you're talking about liabilities, you're talking about transportation. It's like you've got opportunity almost everywhere that you can look.
Well, there's certainly plenty to do and tremendous opportunities in the non-admitted space these days. But these 3 or 4 that I mentioned are very acute. And, that's where the most non-renewal notices and, as I said, dumping and shedding by the standard market is occurring today as we speak.
This is going to be a discussion that could easily become obsolete given what happens with Hurricane Milton. But would it have been right to describe that the property cat market had, on the insurance side, on your side, had probably stabilized? Would that be right to say that the more of the greater demand was now away from property cat exposed property because that capacity had reset and was now available, was able to meet demand? How big a caveat would be something like Milton? We don't know how big it's going to be. I presume that's going to, again, be something on your radar to say, well, this could set this all off again.
Well, I think that there was some rate deceleration in certain parts of cat, but the overall property market remains very strong. We expect it to be a strong contributor to our success this year and certainly next year. We're watching the estimates, as many are, on Hurricane Helene come in at 10 billion plus at a minimum. And of course, tomorrow, we're watching Hurricane Milton. We hope everyone in its path can safely navigate through the storm, first and foremost. But we're very bullish on property, actually. It's just too volatile, and there's too many segments in that business that are difficult. Wildfire, flood, convective storm. I mean, the convective storm losses are staggering. So it definitely a rock solid flow of business in E&S. And then we remain very confident that casualty will be a strong driver for us this year, the fourth quarter, big casualty quarter. And, the higher loss trends, as you know, driven by economic and social inflation, continue to drive business into our channel. Reserving issues due to the long tail nature and latency in claims and higher reinsurance costs all play a role in driving that high hazard business into our channel. So in our environment right now, it's just critical for these clients to get the specialization, industry specialization, and product level knowledge that they need. So we pride ourselves in that. We pride ourselves in the breadth and the depth of that knowledge and technical expertise. So we're excited that we can bring more value to our customers.
It is amazing, isn't it, when we think that we could have been at a conference 10 years ago and everyone's saying, we talk about P&C. Well, actually, we should start talking about it being C and P because, casualty is where all the growth is going to be and property is going to stay static because it's tangible risk. There's only going to be so many buildings in the world and we worked out how to insure them. And of course, lo and behold, as soon as someone said that, property became dynamic because we know it's static. We know where it is. But it was the atmosphere around it became more dynamic, the severe convective storms and all the other things that can happen, of course, and you can't move a building out of the way. And I completely concur with you on what you've just said about casualty. I've just put out my Monte Carlo documentary style podcast after a huge amount of conversations with reinsurers and reinsurance brokers down there. And yes, casualty, that took up more than half of my time talking about the nuances and worries. Obviously, we've had those deteriorating years from last decade, but that creeping realization, or at least a fear, that some of the post-COVID years, although they're not mature, some of their early numbers aren't that great. And, they're certainly on frequency and potential severity, they don't look magnificent either. So again, there's a certain hesitancy there. So yeah, it sounds like there's jobs to be done all around for someone in your business. One more question I want to ask you. Again, I suppose it ties into your wholesale globalization. In the wholesale world, we have one global institution, which is Lloyd's. And Lloyd's has changed a lot in the last few years. Certainly, there's been a renaissance, there's newfound confidence. There's a new attitude to a broker and MGA-backed syndicates. And there's so many structures now available, the alternative capital structures and other syndicates in boxes and other things available to new entrants. Could now be a good time for you to have another look at this old marketplace, particularly as you're globalizing?
Well, Lloyd's, they continue to be an incredibly constructive trading partner for Ryan Specialty in both delegated authority and broking. They're just a tremendous partner, and they do so much for us and others in the non-admitted space traditionally, and even more so today. Their ability to get into these niches, whether it's binding authority, programs, MGUs, and broking here directly in the US and certainly through our favorite London brokers. So in addition to the concerted efforts to digitize their platform and eliminate inefficiencies via the blueprint, they've done an even better job, in my opinion, in commercializing the platform through initiatives like the London Bridge in an effort to bring new forms of capital to the market. I mean, no one does it better in a global sense.
Do you think there might be any interest in, obviously lots of MGA businesses have been able to start some of their own syndicates, perhaps sometimes taking a share across their portfolio, that kind of thing. Do you think any of those might appeal to you?
Well, I wouldn't rule it out, but it's certainly not a priority for us right now. On a going forward basis, we continue to be avid supporters of that market, but we don't see ownership or launching of a syndicate as the key to our strategy at this time. The rationale being we have strategic trading partners with syndicate platforms already, and the necessary infrastructure to bring alternative capital to the market. That's really what we're focusing on.
That's interesting. Of course, you're already producing a huge amount of business into the Lloyd's market one way or another anyway.
Yes, they're just a tremendous partner for us, Mark.
Well, we couldn't be sitting in 2024 and not talk about AI. I suppose ever since probably about 18 months ago, it's been something that I feel I have to talk to everyone about. And I know, Ryan Specialty, you've been big investors in technology, certainly for trimming out any inefficiencies within the value chain, particularly as you're an extended part of that value chain, which historically used to add cost. And so you've always got that incentive to try and strip out any extra cost that is arising. Where are you seeing the best applications of AI within your organization?
The best way for me to answer the question is to really start with how we think about AI at Ryan Specialty. And I think the first step, maybe and one of the most important, is that we've made a strong foundational investment in our technology, as you said, electronic trading platforms, workflow solutions, getting into the cloud. This will accelerate our ability to harvest insights and implement AI solutions across many of our segments. And we've developed and cleansed and curated a one-stop shop for data to feed various AI models. And we're a company that's rich with proprietary data. We place well in excess of $25 billion in premium into the market. We have historical risk and loss information back 10 years plus in many of our MGUs. So I would say we're pursuing a few different areas right now. Enhancing our underwriting profit is one of them, providing better advice to our clients based on market insight. We're definitely accelerating speed and efficiency and strengthening our ability more efficiently service a growing and expanding number of submissions that we work on, record-breaking submission flow. And of course, with that comes pretty strict compliance and regulatory monitoring. We're very proud of that. And we view AI as another tool in the toolbox, frankly, that supports the overall business strategy. So we're working hard to implement, again, various strategies. We think of the long-term impacts, and they're really underappreciated. So we're excited to continue to make progress in this area. We spend time on it every day at Ryan Specialty.
It sounds like you're interested in it on both sides of the fence in terms of that underwriting skill, ultimately to improve your loss ratio, to make you a better picker of risk, of good risk versus bad, but also trying to improve processing speed and cost. And again, obviously, you've got compliance costs as well. So out of those, which do you think is the most valuable?
Well, I think they all play a role in the decision to really accelerate into AI. Business is so much about speed and efficiency if everything else is equal. And so we see AI just making us so much more efficient and faster and more concise for our customers. So we're excited about advancing down this avenue, and I think it'll make our entire industry more attractive.
The first time I met you face to face was in Chicago, and it was just before the market was turning. It was probably 2018, 2019, just before that broad market turn that was beginning there. And I know you were very excited. And it was an interesting time because I was sort of asking about your business, and this was a chat in a cafe in Chicago. And you were most excited about how you were going to handle that volume, because you knew that volume of submissions was coming and it was going to be almost an administrative problem and also a personnel problem. Could you hire enough people to man the phones to deal with those queries quick enough so that you could seize on that opportunity? So again, it sounds like speed to market's still really important.
Well, that's a great memory, Mark. Thank you for bringing that up.
I'll never forget that, because you're the first person who actually told me that the market was turning, and you had great conviction. And of course you were right.
Well, it's a fond memory. And I would say that the volume of business that has moved into the E&S sector over the last decade, as you pointed out early on in our conversation, has been historical, looking back on it. And so we knew, as we have for quite some time, and we certainly know today, that breadth and depth is so important, and high quality ability to handle these transactions at a high rate of speed, but not lose, the effectiveness and the accuracy of building these solutions and serving our clients. So, the winners, there's several of us, and there's many winners in our industry, but the real champions understand the constant challenge of recruiting, developing, and building talent. That's what wins for our customers. They want the front end talent, but they want the depth and the breadth to be able to handle these transactions from top to bottom. It's a long-term commitment to service these practice group verticals.
So you've got to be quick, but it's got to be really detailed and really good all at the same time.
Exactly.
And if you've got an artificial intelligence indefatigable sort of assistant to assist you, you can be so much more productive, can't you? If that assistant is going to read 150 inspection reports of a property program, then so much the better. If it can flag up things that you wouldn't necessarily have had time to do yourself, that can be really helpful. Kind of anything that can save time and it can pinpoint potential problems.
Exactly. We're really excited about what it can do for us.
Well, Tim, thank you so much. I think I've come to the end of my questions. So unless you've got something to add, I just want to thank you so much for giving up some time and coming on the show and checking back in after a few years. Everything's changed so much in the last few years. I'm sure by the next time we get to talk, you get another spare hour, things will have changed hugely again. So I'm really looking forward to that. And I wish you well along the way.
Well, thank you so much, Mark. It's always a pleasure to be with you. And you really do have some great questions. And it's been a fun engagement here this morning. So thank you.
Thanks so much. Yes, I can ask the questions, but if you don't answer them, Tim, then I don't have much of a show. So thank you so much for doing that with great candor and great thought and insight. So thank you very much. And looking forward to having you on the show next time.
Well, again, thank you, Mark, and all the best to you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.